Welcome back. Now, weaker oil prices and lower sales volumes have weighed on Sasol's interim performance. The petrochemical company said sales volumes slipped due to lower production and weaker market demand. Sasol implemented stringent cost and efficient capital management to offset the impact and improve free cash flow generation. Company CEO Simon Baloyi joins us now for greater perspective on the performance. Thank you so much for your time, Simon. Actually, just to start us off, please can you describe this reporting period for Sasol? I don't know if difficult would be sufficient.
Thank you, Zinati. And thank you for the invite. Yeah, H1, I will not necessarily categorize it as difficult. It was just an obstacle, normal internal and external challenges. Internally, you saw we had a 5% drop in our volumes. Externally, we faced difficult macro conditions in terms of the Rand oil price and exchange rate. However, our teams have actually responded positively to that. So what we did, we proactively took control of our cost. We made sure that our cost increases, if you compare the corresponding period, is only 1%, which is way below inflation. And our CAPEX, we now guide into the lower end of our CAPEX guidelines. So for us, if you look at H1 performance over the last 5 years corresponding period, it's actually on par, notwithstanding the macro conditions. So I'm well pleased that we've laid a strong, solid foundations. The volume was driven by coal quality, which we, as Team Sasol, we've now taken FID on the destoning solution, which is going to help us start to control that quality.
Quite a lot of things that I want to drill into there, Simon. Firstly, just starting off with pricing. Of course, you mentioned the external and internal headwinds, but external, we look at the oil price there that was not so favorable. Do you see the current price cycle maybe lasting longer than anticipated, particularly looking at the focus on the oil market and the current U.S. administration?
Yeah, the outlook for oil is that, it will continue at the current level, so actually start trending lower. So we're preparing ourselves for that. We spoke about during the market call this morning that our cover ratio, we usually only hedge both oil and the Rand for 12 months. We've extended that cover for 18 months.
Okay. All right. And just on the chemicals, it would seem that on the price front, it is on a more elevated level. How is that looking like?
Yeah, the chemical prices, the market is still subdued. However, if you look on a half-year to half-year comparison, we see the average basket prices of chemicals going up for up to 6 to around 8%. However, the market, especially in Europe, is still depressed due to high energy input costs. We're seeing some slight recovery in the average pricing in the US. Our focus, however, as Team Sasol, is to focus on what we call the self-help measures. It's what we can control. So we focus on making sure that we prioritize value over volume. As you listened in the call this morning, we've already dealt with non-performing assets. We have shut down some of the assets in the US and in Italy, in the Italian and the German business, where we've mothballed those assets to make sure that we prioritize value over volume. So we're not running assets which you'll call it, they're almost bleeding us because of the negative margins. So those assets have been mothballed to help us deal with the prevailing marketing conditions. What we focused on is to make sure that we achieve an EBITDA uplift. If you look at the international chemical business, we used to run at an EBITDA of around 2 to 3%, when our peers were well above the 10%, almost the mid-teens. So we're also targeting that this business should uplift the EBITDA to be on line with their peers.
We'll talk about that international chemicals business. Of course, earlier on in this year, there was a buzz over potential IPO. And I'm wondering if maybe your outlook on that, and if that is a conversation at Sasol, and maybe it would be a thing of happening sooner rather than later, if it is a conversation, or maybe investors took something that was maybe planned for later on as in something that could be happening soon.
The IPO or any strategic action that we'll take with that asset. It will happen later on. However, it's absolutely critical that right now we focus on turning around the business. And as our results are showing now, and it will show at year end, we are well on track on making sure that that business returns robust returns to the shareholders. Once that is achieved, it does give us, strategic options in terms of how to go with it forward. And IPO or listing separately is one of the strategic options open to us, but it's not the only one. There's many other options that we can exercise in terms of that asset.
Simon, you mentioned earlier, of course, that you have been on a cost-saving initiative, but also at the same time, you are experiencing higher costs that keep creeping in, to name a few. The external coal purchases, the capital cost of the destoning unit, higher chemical feed costs, feedstock costs. Is that cost curve maybe proving quite difficult to navigate?
No, not difficult to navigate. However, it's a challenge that we're facing head on. Like I previously said, if you look at our cash fixed cost, both labor and maintenance, year on year, if you look at the corresponding periods, we're 1% low, which is actually way below inflation. Our capex is in range. We did give the market a guidance of 28 to around 30 billion, and we're now targeting the lower end of that range, and we're focusing again on self-help measures. We're making sure that we can contain the cost. You remember when I started in April, we started with an organizational restructuring, and that has helped us to improve agility, but also to remove duplication in the organization and contain the cost. We're going to continue with that process. We're busy reviewing our supply chain, making sure that we implement commercial excellence programs to make sure that we review all the contracts and we pay fairly for the goods and services that comes into the company. And that creates value for both us and the customers and our providers. We have to make sure we find that win-win balance. So cost containment, it is going to continue in a responsible manner. And finally, on this topic, you mentioned the purchase of coal. Of course, that is, for us, coal is about quality first. We have to make sure whether we mine the coal or we purchase it, that we first balance the quality. We're going to continue with that program, maximizing the quality. And then secondly, it will be on cost efficiencies. And that cost, we first have to spend cost in mining to improve flexibility of that resource so that it allows us to have that optionality to either mine the coal or buy the coal outside. And that will make sure that we can supply Secunda with the right quality coal at the right cost. And we'll manage cost in that manner going forward.
And just lastly, as we look out to the second part of the financial year, besides the seasonal effects, would you say that there is enough support for a better second half?
Yeah, definitely. Usually in the first half, which is the half that we just went through, that's when we do most of our shutdowns. There's lots of capital outflow out of the organization. So the second half traditionally is actually our better half because we've got all our assets available to us. You remember we had the fire at Natref. That asset is back online. We're going to also make sure we continue maximizing the quality as far as we can before the destoning comes in to protect the volume guidance that we've given for Secunda. There's no major shutdown planned. So notwithstanding any major changes in the macros, the second half should be much better than the first half.
All right. Well, thank you so much for your time and giving us more detail on those numbers that came out from Sasol. That was Simon Baloyi, CEO for Sasol.